Hey, good morning, everyone. My name is Bert Salazar, and I'm going to be the host, your host, for this short webinar today. We should get started in about 2 minutes. I can see that we have people coming in now, and once I start broadcasting, then all of you can come in and join us. We're actually living through turbulent times. As you know, the coronavirus has impacted not only the United States, but also the entire world. So what I'm going to do today is I'm going to talk about the impact on the coronavirus, but most important, what it does to all of your finances, all of your investments, all of your retirement accounts, and so forth. So I'm going to try to, get you to think outside of the box, which is something very, very unusual for most of us. But that's my job. So I'll tell you a little bit about myself once we get started. I can see we got more and more people signing in now. So we got about a minute left. Get ready if you haven't had any coffee, because I know it's a Saturday morning. Get your coffee ready, get your water. What I do recommend is kind of shut down your cell phone, because the information that I'm going to give you is going to be very important for all of you. So hope you pay attention. I'll open it up for questions at the very end. So if you have any questions, you may want to jot them down, and then I'll be able to answer those questions for you if we have any time left. So I hope all of you are doing well. I woke up this morning at 5:30, as I normally do. I went to the gym and I got back and I turned on the news, and it's all about the coronavirus and the impact that that's having, throughout the world and throughout the United States, when it comes to businesses, the airline business, you name it. The medical facilities are suffering heavily. Restaurants are shutting down for the time being. Major sporting events are being either done away with for the entire year, or they're postponed to a later time. I was supposed to go to a conference in Jacksonville, Florida, in which I'm asked to go every year and speak, and it was going to be now March 23rd, but they had to postpone that until August. So the impact is going to be tremendous. The stock market has been going up and down like crazy, and it will continue to do that. And that's where we're going to be spending our time today. So let me see, now it's 10 a.m. on the East Coast. We do have some clients and friends that are joining us from the West Coast as well. So good morning to all of you. I know it's bright and early over there. So once again, for those of you who don't know who I am, my name is Bert Salazar, and I'm going to be the host for this webinar today. What I will be doing is I'm going to shut down my video, so you don't have to look at me through my entire presentation. And then at the very end, I'll turn on the video again and make sure that I can answer any specific questions that any of you have. You also have the ability to chat. So if you want to send me a message via the chat portion of this webinar, then feel free to do so. I'm not going to look at it because I'm the only one doing this today. I don't have somebody, managing that part of it for me because it's a Saturday. But I will look at it at the very end, and then I'll be able to answer questions for you. Okay, so let me go ahead and shut down my video so you don't have to look at me for now. And let me go ahead and share my screen with all of you. And I'm going to be sharing my desktop. You should be able to see it now. So again, I decided to name this webinar, Has Your 401k Become a 201k Overnight? And that is something that is happening right now quite often. This week alone, I must have gotten, I don't know, 18 to 20 calls from existing clients that have money in the market. And they're petrified. I mean, they're looking at their account values going down by 10, 15, 20, 30%. And they're asking me, is there going to be an end in sight? What are some of the things that I may be able to do in order to alleviate this nightmare that we're going through? So that prompted me to put together a short presentation for all of you that you can take a look at. Now, one of the things that I want to do is, before we get started with this presentation, I want to take you to some calculations that I did yesterday, and I'll bring that to the forefront because I think it's very important for all of you to get a clear vision as to, how the market works, how you need to invest in the market, and what are the things that are very critical for each and every one of you that you must be able to do if you want to protect your retirement assets in the future. Now, as you all know, pretty much all of 2020 gains, all of 2019 gains, and most of 2018 gains have been wiped out. And what it took you years to build have pretty much been wiped out in a 2-week period. And that is really, really sad. If you can allow your retirement assets to be pretty much wiped out or reduced by 10, 15, 20, 30, 35% in a matter of a couple of weeks or in a matter of pretty much overnight, then you really don't have a retirement plan. Just think about that, let it sink in, because unless you take proper measures, you really don't have a retirement plan. So I did 3 calculations that I'm going to walk you through right now, because I don't want to keep you here much longer than we need to. The first one on the top left is I looked at what the market had done in December of 1999. So when the Dow closed, and I'm looking at the Dow Jones, I could do the same calculations for the S&P and the NASDAQ and so forth, but I just want to concentrate on the Dow Jones. If you look at the Dow Jones in December of 1999, it closed for the first time at 10,000, as you see there on the top left-hand corner. So I said, well, where, the market was at 10,000 in 1999. Fast forward 20 years later, the market is now at 23,185 as it closed yesterday, because the market did go up a bit yesterday. So over a 20-year period, what is the average rate of return for the stock market at a point in time where we have had a 10-year bull market that we have never had in the history of the world? Well, the average rate of return, as you can see there, was only 4.29%. So for those of you that think that, if the market goes up 20% or 15%, at the end of the day, most of you are going to be averaging anywhere. Actually, many of you are going to be averaging less than that 4.29%, because you allow fear to take over your decision-making process. So what I'm looking is at the market overall. Now, if you look to the calculator on the right, I took the same 10,000 as of December of 1999. And then I used the number that was around, 3 weeks ago, which was 29,343. So actually, the Dow Jones has dropped from 29,000 and change to 23,000 and change in a matter of 2 weeks, pretty much, okay? So if I look at the 10,000 in 1999 and compare that to the 29,343 of 2 to 2.5 weeks ago, the average 20-year rate of return, and again, at the biggest and longest bull market in the history of our country, is only 5.53%. And then I wanted to do another calculation. I went back to 1900, which was a year when we started to keep track of the Dow Jones and some of the other bodies of investments and what they were doing on a daily basis. And when the market closed in the year 1900, the Dow was at 65. Now, fast forward to today, the market is at 23,185. And then obviously that's over a 119-year period. Take a look at the rate of return over 119 years in the market is 5.06%. So what I'm trying to share with you here is that it doesn't matter what you do. It doesn't matter what the market does during specific periods. Your rate of return overall over the long term is going to be anywhere between 4 and 5%. If I average all these three combined, it's about 4.92%. The challenge is that most of you obviously are not going to get that rate of return, because you're going to be buying and selling at the worst possible time. You're supposed to buy low and sell high. Well, most of you today are buying high and selling low. So those are things that I wanted to do and bring it to your attention as a preamble to our webinar. So just bear in mind that if you can avoid losses in a portfolio, I don't care if you're getting 3, 4, or 5% return on your investment. you're going to be doing much, much better. Because for this type of risk that all of us and all of you are taking today, you should be averaging at least 8%. Number one, you should be getting anywhere between 4 and 5% for the risk that you're taking in the market. So if you can lose, and you can get wiped out 2 to 3 years of gains in a matter of a couple of weeks, then you should be expecting a higher rate of return for that. And on top of that, just to keep up with inflation, you should be receiving anywhere between 3 to 4% of a rate of return on that. So at the end of the day, if you're not averaging anywhere between 8 and 9% in your investments on an annual basis, then you should be doing something else with your money from a business standpoint. All right. So now that we've had a conversation about this, let me bring you to our presentation. And again, my name is Bert Salazar, and I'm the host to this webinar today. So I named it the right way. Has your 401k become a 201k overnight? Because I'm now seeing some of the statements that some of my clients are sending to me. By the way, we do webinars, we do seminars, we do podcasts. I have a YouTube channel, I have a Vimeo channel where I put a lot of information. And some of my podcast clients are actually calling me and sending me their statements for me to take a look at and see if we can do some proper asset allocation. But obviously that's not something I'm going to handle at this point in time because I'm a tax planner. So I'm in tax season. Monday, March 16th is the deadline for corporate taxes. So I'm very, very busy. And then starting Tuesday, I start on the personal income taxes. So I'm going to be busy through the middle of April. And the IRS may be extending the tax filing deadlines for individual income taxes. So I'll keep you all posted once we get the feedback from the IRS. Now, for me, the definition of insanity is always the same, is doing the same thing over and over again and expecting a different result. I would argue that most of you continue to do the same things over and over again while you're expecting a different result. And when it comes to managing your portfolio and managing your retirement assets, you have to start thinking outside of the box. And I have a whole presentation that I do along those lines, but I don't have the time to share that with you today. Now, food for thought, something that I call the Titanic syndrome. And the Titanic syndrome, I don't know if you've seen any movies or if you've seen any information regarding the Titanic. I love the story of the Titanic, so I've done a lot of reading. When the Titanic sank in 1912, employees were actually filmed rearranging the chairs on the Titanic after it hit the iceberg. So my point and my correlations to what we're talking about today is, are you just rearranging the chairs on your financial Titanic? It just hit an iceberg, which is the coronavirus, and most of you are still sitting on the assets. You see your assets are losing value every single day. You keep questioning yourself, when is the time for me to get out? And you're still sitting on the sidelines waiting for that to happen. In the meantime, your assets continue to head south. Most important, if it's very critical to understand when it is time to get out of the market, it is also important once you're out of the market for you to know when it is time for you to get back in. Because what we have a tendency to do is, most of us that get out of the market, we don't get back into the market until the market has already gone up 10, 15, 20%, because then we start to feel more comfortable. But in the meantime, we lost that potential initial gain of 5, 10, 15, 20% that could have helped us, recover some of the losses that we suffered. But because we were sitting on the sideline, not knowing when to pull the trigger, then that forced us to lose money along those lines. So the bottom line here is, make sure that you're not just rearranging the chairs on your financial Titanic. Now, what we do as a firm, we own 2 companies. I own 2 companies. Gable's Tax Planning Group, that handles the tax planning side of the house. And then Cambridge Financial Partners, LLC, that handles the insurance and the retirement planning. The vast majority of the clients that we engage come through our accounting firm and the tax planning side of the house, which will include accounting, bookkeeping, payroll services, and I do tactical retirement blueprints for clients that may be suitable for that type of planning. And that will depend on your assets, on your age, and what it is that you're trying to do, and so forth. On the Cambridge side of the house, we do a lot of long-term care planning, business services. We do estate planning. I also do Social Security and Medicare planning, which comes based on the type of market that we work in from a business perspective. And then last but not least, on the retirement side of the house, we do pensions, we do principal protection that I'll talk a little bit more about today. And then obviously life settlements, which is something that is primarily for specific investors that want to get involved in the life settlement business. So for those of you that don't know much about me, I have no idea whether I can help you. Well, I know that I can help you. I just don't know if I can save you. But you can feel free. I'll give you my information at the end of the webinar. And if you want to reach out, you can feel free to do so if you have any additional questions. Now, I always say that even a broken clock is right twice a day. So I get calls from clients over the years that say, Bert, my account values are doing very well. And I'm doing very well in my 401ks, my IRAs, my mutual funds, my investments, and so forth. And my answer is always the same. Even a broken clock is right twice a day, because over the last 10 years, even a monkey could have done very well in the stock market. Now tell me how well you're doing today, and I'll find out whether you are a genius or not. And I would argue you're not doing as well today as you've done over the past 10 years. Now, I want to talk a little bit about retirement distribution pitfalls, which are 3 things that are very, very important for all of you to do, especially for those of you that happen to be on the call and you're getting into your mid-50s, or perhaps you're into your early 60s, or you may be in retirement already. Retirement distribution is a major issue, because when you go from accumulation to distribution, now you have to make a complete paradigm shift in the way that you look at your assets. It's no longer about the accumulation rate. It is all about the distribution rate. So these are things that we'll talk about in the next few minutes. Now, Warren Buffett, which is one of my favorite people in the world, he's got 2 investment rules. Rule number 1, never lose your money. In other words, if you invest $100,000 into an investment, make sure you never lose that money. And rule number 2 is to never forget rule number 1. Will Rogers used to say that he was more concerned about the return of his money than the return on his money. So Warren Buffett feels the same way. The challenge for the vast majority of you on the call today is that your account values are nowhere near what they were supposed to be, or what they were 3 weeks ago. And if your retirement accounts can drop so much in value in a period of 2 to 3 weeks after saving all that money for years, then do you really have a retirement plan? I would argue you don't. You have what I call a hope plan. And hope is not a financial strategy for any of you. So I think it's important that you pay attention to what I'm going to cover today. Now, let's talk a little bit about the S&P 500. Let's talk a little bit about bear markets. And we're going to look at the bear market history between 1929 and 2009. So that gives you a flavor for something that's important for all of you to know. Now, historically, a bear market occurs approximately every 5 years, as you see there. The average decline is around 39%. Usually, bear markets last about 1.5 years. But the average time for the regular investor to break in or to break even is somewhere around 5.2 years. So it happens every 5 years. The average decline is 39%. It lasts about 1.5 years, and then it takes 5.2 years to recover. That creates a chain reaction, which I'm going to go into in the next few minutes. Now, one of the things that is very important is that the sequence of returns actually matters when you're in retirement. It's not so much when the losses occur, because when you're still employed, if you're putting money away in your 401k and you're getting a match and you don't need that money, if the market drops, it's not as bad as when you're in retirement and now all of a sudden you have to go into those accounts in order to maintain your standard of living. Because if you start going into those accounts at the worst possible time, when your account values are dropping in value, not only are your account values dropping in value, But most important, now you have to start liquidating assets in order to maintain your standard of living. So you're actually compounding the problem and the effect of those market losses, and you will more than likely never will be able to recover. That's like jumping out of of an airplane without a parachute. Now, for those of you that are on the call today, I would argue that most of you have already done this. Many of you have a lot of money in your 401ks and your IRAs and your traditional mutual funds or whatever it may be, but they're not protected. And because of the fact that they were not protected, you had jumped out of an airplane with no parachute. Now, unless you're planning to commit suicide, then this is not something that you should be doing, especially with your money. So, food for thought for all of you. And I say this often, only when the tide goes down will you know who is swimming naked. So for those of you that have been doing really well in the stock market and your investments for the past 10 years, you know, it's easy. The market is doing well. You could be a monkey. You could take a dart, throw it against a wall, and you can get anywhere between a 5, 6, 7, 8% rate of return. Some of you could do better. But now that the tide has gone down, now most of you are sitting there totally naked, but nobody knew that you were naked to begin with until the actual market took a dip, as it has done in the last 3 weeks. So always remember that only when the tide goes down will you know who is swimming naked. So what is the old paradigm when it comes to retirement planning, retirement preparation, and investing for the future? Well, number one, the stock market is always going to vindicate itself. Number two, buy and hold. It's an appropriate long-term investment philosophy, especially during retirement. Asset allocation is going to protect your retirement assets during volatile market. That means not having all of your eggs in one basket. But the new paradigm is something that you need to pay attention to because you have to have the ability to, once again, start thinking outside of the box. The stock market is unpredictable and volatile. Well, you know, we're going through it today. Number two, buy and hold may be incompatible with a volatile market because the way the market is today, most of the market sectors are actually suffering. So even if you want to hang on, it may not be enough, and it's going to take you a long, long time to recover from a traditional bear market. Now, diversification through asset allocation is not going to be enough because as it happened in 2008, the entire system dropped. And when it dropped, it didn't matter whether you had your money invested at how good of a job you had done in asset allocation, your assets were mostly and totally depleted. A down market at the wrong time may force you to postpone retirement indefinitely. And that is true for many of the clients because I specialize in working in clients that are either 5 to 10 years away from retirement or clients that are already in retirement. So that's important. And many investors, and this is true for most of us, many investors lost between 30 and 50% of their retirement assets in 2008. I hope you don't want to be one of those because we don't know how this is now. We may come out of this one very quickly, or it may last longer, but even if we come out of this quickly, it's still going to take a long time for you to recover from the losses, as I will explain in the next few minutes. Now, let's talk a little bit about the average versus actual. And this is something that I try to educate my clients often. And the reason why I try to do that is because information without education always, always, always leads to failure. So this is something, remember, because the market goes up and the market goes down. You know, volatility in the market often happens. Now, over the last 10 years, we've had a bull market, but over the last 2.5 weeks, we have had a bear market, and the impact is tremendous. So let me give you the difference between an average rate of return and the actual rate of return. And before I go there, let me tell you that the market overall lives on the average. Each and every one of you individually live on the actual. So let's say that in year one, you have a 50% loss. And in year two, you have a 50% gain. Now, over a 2-year period, the average rate of return is 0. And this is what the mutual fund companies and your investment firms are going to be reporting. Okay, Bert, I had 50% losses in my first year and then a 50% gain in my second year. So the average of the two is 0. But in reality, it's worse than that. I know 0 may not be as good as you want it to be, but it's a lot better than what I'm about to show you. Now, again, the markets live on the average, you live on the actual. So let's take a $100,000 investment and let's apply the same formula of a 50% loss in the first year and a 50% loss in the second year and see what it does for us. So if you invested 100,000 and in the first year you had a 50% loss, now your investment account at the end of the first year is $50,000. And then if in the second year you had a 50% gain, now you gained a 50%, not on the 100,000, you gained a 50% gain on the 50,000 that you had left at the end of year one. So you actually now move from 50,000 to 75,000. Therefore, although the 2-year average for the market was 0, your average and your actual rate of return, not the average, was a negative 25%. You see, it takes longer for you to go uphill than it does to go downhill. So although you had an average return of 0, your actual return was a negative 25%. Let me give you another scenario. Again, the same $100,000 investment. You had a 20% gain in the first year, as opposed to a loss in the previous example, and a 20% loss in the second year. So the average rate of return is 0. So if we apply it to actual numbers now, in the first year, the 100,000 grew by 20%. So now you're at 120. By the way, I'm not factoring in fees or anything like that. In the second year, you lost 20%, but you didn't lose 20% on the 100,000. You lost 20% on the 120,000 that you had gained at the end of the first year. Now your investment account is down to 96,000. So although your average return was 0, your actual return was a negative 4%. So if the market goes down by 1,000 points and gains 1,000 points, you didn't break even. And that's what has been happening for the last 3 weeks. So you have to pay attention to that. Very, very important. Now, the sequence of returns matters significantly in retirement, because, you know, as you're putting money away, the impact is going to be less, still going to be there. But, you know, when you are taking money out of the accounts, and the impact is going to be much more dramatic, as I'll show you right now. I don't have time to go into the American Airlines analogy, but that's something that I use in my longer webinars and seminars. And then most important, one of the things that we want to try to do is avoid market volatility and retirement taxation, because otherwise you may become a Walmart greeter at some point in time in your life. And that's something that, unless you want to do it for fun, that is not something any of us want to find ourselves in. Now, there are 2 types of risks when it comes to stock market volatility. One is what I call the unsystematic risk. And that's when, you know, a particular stock goes down in value. So it could be of a single company. Let's say the employee's gone on strike, the CEO dies, product failures, scandals, fraud, whatever it may be. Enron is a prime example of that. The other one is what is known as a systematic risk. And this is the risk that happens to the entire market or an entire economic system. So it could be war, it could be 9/11, it could be inflation, higher taxes, bubbles, as we had in 2008 and we had in 2000, recessions, depressions, what is happening right now with viruses, whether they're natural viruses or man-made. So this is what I know as a systematic risk, what is known as a systematic risk, because it's going to impact all sectors of the market. Now, which one is worse? Well, I would argue systematic risk is the worst, because there's no place for you to hide. So let's take a look at 2007. And this is a prime example of Citigroup stock. And as you can see there on the top right, that's what it did. And obviously that was no good. And that's looking at a particular stock at a given period of time. Now let's take a look at a systematic risk. And this includes the Russell 2000, the Dow Jones, the S&P 500, the NASDAQ, and that was between 2004 and 2009. Look what happened there in 2008 and 2009. The entire sector dropped significantly. Now, the big question to all of you now, not because of what you're going through now, but many a times in the future, there are going to be bear markets that you're going to have to deal with is, how long does it take to break even after a large financial loss in your portfolio? So let's say that you had a 40% loss in your portfolio. In order for you to gain that 40% back in 1 year, you need to get a 67% rate of return in order to break even in 1 year. Now, most of you, I have not seen a 67% rate of return on any given year in the history of the market. So, but let's say that you can get an 8% rate of return. Well, it's going to take you 6.6 years just to recover from a 40% loss in 1 year. And if you then every year thereafter, you're getting an 8% rate of return, which is a very good rate of return, by the way, it's still going to take 6.6 years for you to recover from that 40% market loss. You better pay attention to this, and you better pay attention, especially if you're closer to retirement now than ever before. Now let's take a look at the S&P 500 over the last 20 years. Take a look in 2000, which is the first peak that you see there on the left. And then look what it ended up in 2003. So by the end of 2003, the market had been down 49% from its highest in 2000. That is a dramatic drop. But most important, take a look at how many years it took. If you go to the second peak there toward the middle of the page, it took between 2003 and 2008 for you to get back to where you were in 2003. By the way, if that were to happen to you in retirement, how many of those peaks and valleys do you think you can deal with in retirement? I would argue zero, none of it. And then all of a sudden, we get to that peak in 2008, and then we all know what happened. And then by 2009, we were down 57%. And then it took from 2009 to 2014 for us to come back to where we were. But in the meantime, you'll never catch up. Why? Because inflation is not tax deductible. And while your account values were down all that much for that period of time, inflation continued to head north, and therefore there was nothing that you could do. So what you need to try to do is you need to make certain that if you can avoid those valleys and just concentrate on the peaks, then obviously you would be on top of the world when it comes to your retirement assets. Now take a look at the history of the market between 1999 and 2015. Let's take a look at the one on top, the Dow. Again, I told you, in 1999, it closed at 10,000 for the first time. In October of 2007, it closed for the first time at 14,700. And that was the first time in history that the Dow had hit 14,700. And then by March of 2009, the market was down to 6,700. And then it kind of fought its way back and it crawled back up. And then by December of 2009, it got back to 10,000 again. So we call that the decade of nothing. Started at 10,000, it ended up at 10,000. And in the meantime, inflation, taxation had a negative impact on everything that you did. So there was no way that any of you were ever to recover. Most of you that went through this have not recovered as of today. Now look at the NASDAQ. In 2000, it hit 5,000 for the first time. The next time that it hit 5,000 again was in 2015. So that they actually the NASDAQ went through a 15-year hiatus. And by the way, I'm educating you on this because this is very, very important. You need to take this with you because what happened in the past is going to happen again, and you need to be able to prevent it. Now, questions are, what's going to cause a market crash? Well, pretty much anything can cause it. Interest rates jumps, any type of interest rates, when interest rates go up, the markets go down. Cyber attacks and disruption to power grids, and those are things that we see throughout the world, and everyone is very concerned about that. World leaders with their fingers on the trigger, and you have no control of that. Emerging markets in distress or chaos is something that none of us can control. Trade wars, internal cracks, political impeachments. We just went through one of those not too long ago, investigations. Tax laws and governmental regulation changes is something that we're going to start seeing pretty soon. We only have a 6-year window under the new tax laws. And when we all wake up on January 1 of 2026, taxes are going to be much greater than they are today. Tight labor market in the US, and that's something that we're starting to see because unemployment is so low as it is today. Inflation and deflation fears. Natural and or man-made viruses like coronavirus. So anything can have a negative impact on the market. So if that is the case, and you just jump out of that airplane with no parachute, how do you think you're going to land? You're not going to land. You're going to die. And your assets are going to die. And the worst thing that's going to happen to all of you is that you're going to run out of money before you run out of life. And living a long life creates a problem for each and every one of you that you need to make certain that you can protect. Now, let me give you one factor that is very critical, and this one deals with retiring at the right time, because a sequencing of return is very critical for all of us. And you have to now, when you get ready for retirement, you got to say, well, is it the right time for retirement or not? Let me give you an example. Portfolio A on the left. Now we're talking about somebody that put away, they have $100,000 in a portfolio. Portfolio A and Portfolio B, so two families, they have $100,000 each. They're 40 years age. They are getting an 8% rate of return on their money. And then at age 65, notice that the value of the Portfolio A is $684,848. And the value of Portfolio B is the same, $684,848. And it didn't matter where the losses occurred. So yes, you could see there in Portfolio A, you had 3 years or continuous losses, where in Portfolio B, the losses occurred at the very end at the age of 65. Now, that is while you're putting money away and not touching the money. Now, as Paul Harvey used to say, what is the rest of the story? Well, let me take you to the rest of the story. In this scenario, now they are in retirement. Now the sequencing of returns are going to play a major role. They're going to be withdrawing, both families are going to be withdrawing 5% out of that $684,000 of change. And they're going to continue to receive an average, remember the key word, average rate of return of 8%. And voila, take a look at this. The person or the family in Portfolio A that suffered the first 3 years of losses in retirement while taking money out of their retirement accounts in order to maintain their standard of living, they ran out of money a lot quicker than the family in Portfolio B that did not suffer losses in the first 3 years, to the point that by age 81 or 82, the family in Portfolio A, Houston, we have a problem, we ran out of money and we're still alive. Here comes an application to Walmart. And in Portfolio B, at age 90, this family still has $2.6 million in their retirement account. So if you don't think that the sequencing of returns makes a big difference in your retirement calculations, then obviously you need to pay attention to calculations and math a little bit closer than you're doing today. This is another sequence of return sample, and this is George and Jane. George retired at a good time in the market, where the first year he got a 26.6% rate of return, 19.5% in the second year, then had 3 straight years of losses. Jane, on the other hand, retired at the very beginning of those losses of 10, 13, and 23%, and check out the difference. Obviously, Jane ran out of money much sooner than expected because of the timing of those losses as well. So the summary for this part is that you need to understand the difference between accumulation of assets and distribution of income. You also need to have a well-structured distribution analysis that can identify your future retirement hurdles and how to deal with those. The protection of capital assets are a must in retirement for all of you, and that's important. So now what I'm going to cover is, well, Bert, this is all well and good. You've given me a lot of information. I'm scared. I don't know what to do with my assets. You know, maybe I went to cash, but I don't know when to get back in. Or I'm still invested on the market. How do I stop the bleeding? You know, what are some of the things that you think I can do? Well, I'm going to start walking you through the things that are important for you to do at this point in time. Now, one of the questions I normally ask my clients is, you know, what's better, a hammer or a screwdriver? And the answer is, well, it depends. It depends on what you're going to do. The hammer could be good for some things, and the screwdriver obviously will be good for something else. But what I'm going to talk to you today is how to create a portfolio protection program that now is going to alleviate the fears of losing money at the worst possible time. Because if your retirement assets have dropped significantly over the last 3 weeks, then you really have no retirement plan in place, and you need to be talking to me. Because otherwise, the same thing is going to happen down the line, and you have no protection, and you're going to be, again, the tide is going to go down, and everybody's going to know that you're swimming naked. So now there are different types of portfolio programs. It's just like Baskin Robbins, so 31 different flavors. My job is to identify which product and which service is going to be the most suitable for you. The key is, can you have your cake and eat it too? Can you put your retirement assets in an investment where you have growth potential, that your principal is always protected? Some that may be interested in having some long-term care benefits as part of their portfolio. And then some of you may even be interested in income benefits. By the way, if you're in a 401k or any other type of retirement account, unless you have guaranteed income, you have none. If you happen to be a public employee and you happen to have a guaranteed pension, well, you're sitting at the top 1% of the food chain. But guess what? Any money that you have in a TSP or in any type of investment account, you better be able to protect that, because your pension benefits are not going to grow fast enough to stay ahead of inflation. And therefore, your TSPs, your IRAs, your non-qualified deferred comp, your 401ks need to stay ahead of inflation. And the best way to do that is not to suffer losses. If you suffer losses in your retirement accounts, you're going to pay the consequences for the rest of your life. Now, there's a product which is a very suitable product for the vast majority of my clients. Now, again, there are differences between all of these products, so I'm not going to go into any details, but these are fixed index annuities, and I'll tell you a little bit about how they work. Think of a fixed index annuity as playing blackjack. Let's say we all get together and go to Vegas, and we're going to sit at the blackjack table. I don't know if you guys know how to play blackjack, but at the end of the day, when you play blackjack, you can win, you can lose, or you can tie the dealer, which they call push. So that means you can do one out of three. Now, what if we're all sitting at a blackjack table and the dealer says, hey guys, for the first time in history, I'm going to make a change in how we're going to be playing blackjack. And you say, well, what is that change? And is that going to benefit me? And the dealer says to you that moving forward, you can either win or push, but you can never lose. Now, the question I'm going to ask all of you, and it's an important question, so you better pay attention. How long do you think you would be sitting at that table? Well, from my personal perspective, ladies and gentlemen, I am going to be sitting at that table for the rest of my life. Because if the worst that I can do is tie and not lose, and I can also win, then I'm going to have to be at that table forever. They're going to have to bring me an IV and feed me at that table. And they're going to have to bring me a portable shower so I can take a shower and continue to sit at that table. Well, that's what fixed index annuities do to your retirement assets and the importance of your retirement portfolio, because you can either win or push, but you can never lose, and you're not going to be suffering those valleys that I just went through a few minutes ago. So take a look at what it takes to break even. And this is, we already covered a portion of this, but this is going to be something at different rates of return. So notice that it's much harder to go uphill than downhill. So if you lose, let's say 35% in the market, it takes a 53.9, almost a 54% rate of return for you to break even in 1 year. Losses come quickly, gains take longer. So think of it this way: for 10 years you've been in a bull market, we've only been in a bear market for 3 weeks, and most of your assets are gone. By the way, there's no one on this call that can tell me what the average rate of return on your retirement accounts are. None of you. Those of you that have a TSP, you don't know what your rate of return has been over the last 10 years or 15 years or 20 years. Why? Because you've been making contributions. You've been getting a match. The market has been volatile. So you really don't know what your average rate of return has been. You'll never know what the average rate of return has been. For those of you that are in a 401k and IRA, the same thing. You've been putting money away all this time. You don't know what the average rate of return it is. Well, in a fixed index annuity, I can tell you one thing: you're not going to lose money, and your rate of return will more than likely often go up and never go down. Retirement distribution may delay recovery for many years. So if you got to take money out as you're losing 20, 25, 30, 35% on a given year to maintain your standard of living, you're never going to recover from a market loss. Forget about what it takes to break even. You're not going to break even, because you're invading principal and interest out of an account that is losing value. And then on top of that, taxation, inflation, and market volatility are the nemesis of a successful retirement plan. So people say, well, Bert, where does a fixed index annuity fit in my retirement portfolio? Well, if you take a look at this slide here, take a look at the red line. Anything above the red line, you have risk. Anything below the red line, you don't have risk. Now, you may have other types of risk, but you're not going to have any volatility risk. So if you're at the very, very bottom, where you're in cash and CDs, then you don't have any volatility risk, but you have interest rate risk. Now, you still need to have a little bit of money there in your taxable bucket for emergencies and so forth. But then if you go to the far right on the top, where you have your stocks and mutual funds, then you have a lot of volatility risk there, but you don't have interest rate risk as you did on the other one. Now, you have a propensity to make more money, but you also have a propensity to lose more money. When you look at fixed index annuities, they happen to be right in the middle, right below the volatility risk line that you see there, the red line. Which it means is that because they're right below that volatility risk, your principal and the gains are always, always, always protected, but yet you suffer no losses. So if you had $100,000 into a fixed index annuity, that $100,000 is protected. If in the first year your fixed index annuity goes from 100,000 to $10,000, now your new guaranteed protection is 110,000. So if it goes the following year, the market drops, you still at 110,000. Now, how much easier is it for your account values to grow when you don't have to recover from a market loss because you have to work a lot harder? Here, if the market drops 20% and you're 110, and the following year it gains another 10-15%, then you're naturally heading north from 110,000, not from losing all that money as you would have in a traditional stock or mutual fund. So depending on your age is where I feel you should have a portion of those monies into a fixed index annuity. So if you happen to be 50 years of age, 50% of your money should be invested in a principal protection program. If you happen to be 60 years of age, it should be at least 60%, and depending also whether you're conservative or an aggressive investor. But I don't find too many aggressive investors when the market is down. And this is a sample illustration of a fixed index annuities. Notice the account values, the next to the last column, going up every year depending on what the market is doing. But look, like in year 7, there's a 0. That means that at the end of year 6, the market returned 7.66%. So now your $100,000 investment is worth $157,000. And then in the following year, the market dropped. It could have dropped 10, 15, 20, 30%. It didn't matter to you because you stayed at 157,000. So when the market started gaining back up again, now you get to 169, 190. Then after that, the market dropped again and you stayed at 190. So again, like playing blackjack, you can either win or push because you will never lose. How much better would you feel today if 100% of your money during this bear market would have been in a fixed index annuity? I bet you would have felt a lot better than you do today. And then obviously the end of the sample illustration gives you that the average rate of return has been 6.74%, which is much, much better than the historical average return in the market. And the reason for that is because since you didn't participate in the losses and you only participated in the gains, you actually did much better over the long term. Now, so we're approaching the end of the webinar. Obviously, when it comes to risk mitigation, is something most of you have never paid attention to. You need to manage risk when it comes to your retirement assets. We all buy life insurance to protect our lives in case of a premature death. You buy auto insurance to protect your automobiles in case of an accident. You buy homeowners insurance in case you have a water damage or you have a fire in your home. Obviously, it's an asset that you want to protect. You buy disability protection in order to protect your ability to wake up every morning and go out and earn an income, which is the biggest asset that all of us own. And then we all buy long-term care insurance or something similar to that in order for us to protect the risk of living with a disability. So why is it that none of you buy portfolio protection insurance in order to protect your hard-earned dollars and your retirement assets? See, at the end of the day, it's all about landing safely. So the only way that you're going to have a safe landing in your retirement life is that when you jump out of that airplane, that you have the proper parachute in place in order to make certain that regardless of the wind velocity as you jumped out of the airplane and the altitude in which you jump from, that you're going to have a soft and safe landing no matter what. So in summary, you have to understand that there's a big difference between accumulation and distribution. You also need to know that in retirement, the distribution rate is much, much more important than the accumulation rate. The sequencing of returns are very, very critical for all of you in retirement. And if you're in your 50s, you better get ready now. You don't want to start getting ready for this when you're in your 60s. Principal protection and asset hedging, will determine, I would argue, success or failure in retirement. So what are the questions that you need to ask for yourself and your family when it comes to your retirement planning and your accounts? Well, what specific plans have you made to triple your income in retirement? Because you're going to live a long life and you're going to have all kinds of stuff happening to you. So you better know what is it going to take for you to triple your income. What would happen to your financial situation if the stock market dropped 45%, as it did in 2003 and 2008? And we may be very close to that right now in 2020. What have you done as a family to protect your assets from stock market volatility? Because at the end of the day, life happens, and it's happening right now. And most of you are swimming naked. What plans have you and your family made for dealing with the rising cost of healthcare and Alzheimer's in retirement? And what is the impact of your provisional income on your overall retirement assets? We don't have the time to talk about provisional income, Social Security calculations, and so forth today. And then last but not least, what have you done to create a tax-free retirement life? Because if you don't have a tax-free retirement life and you're not hedging and having a proper portfolio protection in place, then your assets are going to decimate in front of your eyes. So once again, I'm going to turn my video in the next couple of seconds to answer any questions. For those of you that may want to schedule a complimentary consultation with me, please give me a call. We can schedule a 30-minute strategy session, no cost or obligation. For those of you that are on this call for the first time, I'll give you a tax-free Social Security and tax planning report. That's very, very useful for all of you, will be for all of you. And then obviously we can determine the viability of creating a tactical retirement blueprint. Again, Bert Salazar, you can reach out to me at area code 786-766-1042, or you can email me at Bert, B-E-R-T, at gablestaxgroup.com. If you have a cell phone in front of you, either write down my information or take a picture of the screen at this point in time, and I'll be happy to answer any questions that you have. And what I'm going to do right now is I am going to stop sharing my desktop to see if we have any questions that I can answer. And then I'm also going to turn on my screen and see if we have any questions that I may answer for any of you. Let me see if you go into your chat, let me know if you have any questions. Oh, somebody went ahead and sent me a question already as to what are some of the vehicles that may be available. And the answer is, when it comes to fixed index annuities, there are a number of different companies. Normally, when I do my due diligence with a client and determine what may be suitable for them, we identify first, what are their ages? When are they thinking about retiring? How much money do they have in their portfolio? Obviously, we're not going to put all the money into fixed index annuities. What is it that they want to do with their money in retirement? What are some of the first assets that are going to be invaded when it comes to retirement distribution planning? How much of their assets would they want to protect from a bear market? Always remember that the fees into a fixed index annuity are very, very low, much lower than in a traditional mutual fund account or IRA or 401k. Because remember, the money managers are going to charge you a fee on your entire portfolio. In a fixed index annuity, you're only going to pay a fee on the increase. So if you put $100,000 into a fixed index annuity, and at the end of the first year, the money grows from $100,000 to $110,000, the fees that you pay, let's say a 10% fee or whatever the fee may be, is going to be on the $10,000, not on the other $100,000. So when you look at the overall rate of return into a fixed index annuity, and the fact that your money is fully protected from market losses, you're all going to do much, much better over the long term than you would otherwise. So I hear people all the time talking to me about, well, you know, what if I get a 20% and a 30% rate of return? Forget it, that's not going to happen. It's never happened. You know, the average rate of return is going to be, you know, less than 5% anyways. So you need to pay attention as to, if you're able to protect your downside, then your upside is always going to be a lot better than if you didn't have that protection, because you don't have to worry about coming up that steep hill, once you lost 20, 30, 40% of your money, because you stayed at the very high level of where you were at before the losses occurred. Another question that I got, what are some of the companies? There are a number of different companies. Again, I don't have the time to go into that today, but there's a number of companies that are there that are available. The longer you stay in a fixed index annuity, the better off you're going to be. So many of the planning that I do for my clients is we start moving some of the monies to a Roth, because right now you don't have to worry about taking any distributions out of a Roth account, because there's no required minimum distributions. And for those of you that may not know this, as of January 1 of 2020, required minimum distributions were actually moved from age 70 and a half to age 72. So therefore, you have a little bit more flexibility on another 2 years in which to not have to worry about taking money out of your retirement accounts, whether you want to or not. I don't see any other questions. I do have a lot of you that have stayed with me till the very end. Thank you so very much. Always remember that my number one goal for each and every one of you is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So again, thanks very much for giving me a little bit of your time today. I thought it would be very important to cover this because some of you are asking for it. And again, feel free to reach out, 786-766-1042, or Bert, B-E-R-T, at gablestaxgroup.com. And let's try to make certain that in the next bear market, or the next time that the tide goes down, that you're not swimming naked, because you need to stop the bleeding right now. You're in a sinking boat and the water is coming in. What, are you going to wait till the boat totally sinks before you start plugging the holes? You need to do it today. Thanks a lot. Have a great weekend and talk to you soon. Take care. Bye.